Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast, edition number 53. This is our 1-year anniversary, and we're recording on May 8th at 5 o'clock Eastern Daylight Time. Here's your starting lineup. Key takes from the April Fed Senior Loan Officer Survey. Some interesting takeaways here. Number 2, the April employment data. Goldilocks is back in town. Number 3, Apollo earnings. When Marc Rowan speaks, we pay attention. So back to number 1, the Fed Loan Officer Survey. Banks are beginning to tighten lending standards and terms to businesses. Higher premiums are being demanded on riskier loans. Banks are tightening loan covenants at the margin. We're seeing tighter collateralization requirements from banks to borrowers. So, all in all, this is resulting in less bank credit accommodation at the margin. I don't think it's anything major, but I think it is a subtle change at the margin. Banks cited a more uncertain economic outlook. They cited industry-specific issues like AI impact on software. And they also cited generally a reduced risk appetite on their part. Now, banks reported tighter standards also to non-bank financials, so private credit borrowers. Non-bank financials still have a strong demand for capital nonetheless. Demand was strong across loan categories, especially from private equity funds, the demand for liquidity to meet redemptions. This all makes perfect sense following the Private Credit Business Development Corp, or BDC, panic of earlier in 2026. And to sum it up, according to our friend Joe Kalish of Ned Davis Research, tightening of credit to businesses and private credit funds should begin to weigh on growth and employment later in 2026. Now, the employment report. The headline was strong, adding 115,000 jobs in April versus a 65,000 estimate. But I pay attention to the 3-month average, which was 48,000, positive 48,000. That's a sustainable, reasonable rate of growth in employment in a zero immigration economy. And we look at the 3-month average because the last 3 months have been all over the place. We've had 185,000 jobs added, 170 lost, and then we get today at adding 115. Well, the average of all this noise is 48, which we think is the right number and the one we want to embrace and pay attention to. Average hourly earnings were benign at 0.2% versus a 0.3% estimate. And year over year, that brings it to 3.6 versus the 3.8% estimate. This is not a problem with 2% productivity growth. It's actually pretty benign and good news. Average weekly hours have been steady for what seems like years at 34.2, 34.3. We're at equilibrium on hours worked. The unemployment rate was unchanged at 4.3%. That also appears to be in equilibrium, and we've been right around this 4.2, 4.3, 4.4 for many months now. But I thought the most important point was resilience amid the headwinds from the war and higher energy prices. There were broad-based gains across many industries in this employment report, and you see this if you dig through the household and the BLS data, which we did. And we found there were big job gainers in healthcare, education, retail, transportation, leisure and hospitality. That's an unusually broad number of industries with gains. And there was really only one significant loser this month, and it was information workers. That's interesting with what's going on in AI. And information workers lost jobs not only in April, but they also lost jobs in March and February. One of the only industries I could find in that fine print to do so over the last 3 months. So I think this is a bullish number. Obviously, it was fully embraced by the bond market and the stock market. It's a Goldilocks number. It's not too hot. It's not too cold, especially when you look at the 3-month average. But the real stunner in today's data, away from the employment number, was the University of Michigan Consumer Confidence Current Conditions series, which printed the weakest in the history of the data back to 1952. Now, let that sink in for a moment. The weakest since 1952? Are things really that bad? Well, stocks are hitting new all-time highs. Employment, as I just showed you, is solid. But the person on the street is very, very gloomy. And I dug into the Michigan report, and here was the sentence that I found that I think sums it all up. The declining confidence was driven by concerns over high prices affecting personal finances. That's what it's all about. It's not about growth. It's about prices. That's where the problem is. Now, on to Apollo. You know, when Marc Rowan speaks, of course, we listen, and we get to listen to him 4 times a year at least. Apollo reported solid earnings in the first quarter of 2026 of $1.94 versus $1.88. That's a modest beat. The reaction in the stock until today was modest. Now it's having a big update today. But we listen carefully to what Marc Rowan says. We know him, we trust him, we respect him, and he always gives you something to dig into. And here are some quotes from Marc. He's seeing strong growth momentum across Apollo's business. Originations were $71 billion in the quarter. He described them as high quantity and high quality. And the interesting thing is he said, based on the pipeline, he expects second quarter loan originations to be even stronger and may even challenge the company's record of $97 billion in originations in a single quarter. Apollo's average loan origination was 350 basis points over treasuries with a BBB rating. Now that's real spread, and we know that they pride themselves on quality of origination. Marc said the world is undergoing a complete geopolitical reset, and that makes the Apollo management wary about what could come out of the blue in a complete geopolitical reset. And here's something that Marc said that I think is consistent with what other major CEOs were saying in the quarter. And I listened to a lot of conference calls this quarter. Marc said, almost everything we are doing as a country, intentional or not, is inflationary, at least in the short term. That was echoed by many CEOs, especially financial services CEOs, titans of Wall Street. Another quote from Marc, we are in the most comprehensive tech cycle we have ever seen. Every job will either be enhanced or replaced. And a new theme is emerging where we see blue-collar workers in ascendancy and white-collar workers under stress. This is a complete reversal from what we have seen over the last 50 years when white-collar workers were in ascendancy and had job security, and now they are the ones under stress. They're also the biggest consumers, and white-collar jobs are, a huge portion of the U.S. job market. Marc said the consumers and businesses are in great shape, but governments are not in good shape, and not just the U.S. in bad shape, but many governments in bad shape. So Apollo continues to be defensive. Mr. Rowan said that Apollo is investing with an eye toward protecting capital. They are preparing to play offense when the cycle turns. And with respect to credit and originations, Apollo is moving more toward investment grade, more toward complex structuring, i.e. protecting themselves, and more toward prudence and protection. So while the world seems to be euphoric with markets hitting new highs and investors being very bullish. One of the shrewdest leaders on Wall Street is getting more conservative at the margin. So I think Mr. Rowan would agree with our close here. Do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.